Once we've found the company's credit rating, as long as it has one, what we want to do is we want to go and look at the average yield for companies in the same industry with the same rating, or if we can't find that, maybe just the average yield for the rating itself. What we're looking for is a way to turn the rating into an estimate of default risk. And the easiest way to do that is just to see what the market has priced other bonds with the same rating, and that will tell us what the market thinks other companies' default risks are, other companies that have been given the similar credit rating by the same agency. And so we can look at the typical spreads, default premiums here. Spread just means the difference between two things. So the difference between the yield to maturity for a company rated A and the risk-free rate, right? That's the yield spread, and it has the same interpretation as the default premium. So for a well-rated company, company rated A, we see that the spread is only 104 basis points. This table's in basis points, and a basis point is 1% of 1%. So 100 basis points is 1% here. We see that the spread of a safe company, one that's rated A or that's rated as safe, has a very small default premium over the treasury bond, and a firm that's been rated double B has about a 3% premium. And that's in 2013, so this is when the economy was good. We would definitely see these spreads become, or these premiums become more significant and more significantly different over time. Again, remember, market rates change as the market changes, and company yields change, and default risks change as we incorporate more information about what the actual risks are. So, I mean, for instance, we can look at it here, we're gonna look at this graph, look at the spread. So treasury is the bottom line in both of these graphs, it's the solid blue line. AAA, that's the safest corporate debt, that's the solid red line. Then the pink line is triple B, that's the bottom of investment grade. So this is right where companies start to become considered more risky, unsafe. And then double B, this is the opposite side of the investment grade line. This is what we call speculative grade. Still considered likely to pay its debt, but much more risky. So look, that the spreads are pretty close. I mean, notice that when times are good, like here you can see in the 90s, the spreads are pretty close, and they're not that big. In the 90s, when the economic boom is happening because of the internet boom, you can see that AAA and triple B investment grade bonds are paying not even 1% more than treasuries, and double B speculative grade paying 2% more. Then during the 2001, 2002 internet.com boost, we see those spreads get much bigger. Even AAAs are paying 1% more, triple Bs are paying 2% more, double Bs are paying 4% more. And then look at the spike during the 2008 financial crisis. We see AAAs considered, almost zero chance of defaulting. They get a jump, of up to 2% default. That's like 4 times what they were paying when times are good. And triple B's up to 4%, and double B's up to like 11%, which is crazy. That means if treasuries were paying like 1 or 2% at the time, a double B rated firm was having to pay 14% interest on a loan, which is nuts. And this is double B. If we jump back here, there's 2 more ratings beneath that in the standard ratings, B and triple C. They might not have even been able to get debt. And then there's junk, right? And junk in normal times might yield, say, 10%. And I've seen junk as high as like 15 or 20, even in normal times. And for instance, right now, we'd see a similar spike if we had current up-to-date data. We'd see a similar spike in yields. And I would expect that some of these companies that are less safe probably can't even get a loan right now, much less have an established yield. Okay. So that's the easy way. If we can observe a credit rating, if we can't observe a price, but we can observe a credit rating, we can estimate a yield using the default premium and a benchmark rate. If the company doesn't have a rating, or they haven't been rated in a while, we have to go out on our own and we have to do it ourselves. So we have to estimate the credit worthiness of the company on our own. In other words, we try to make our own credit rating. And we know that the credit rating agencies use a model as a way to estimate the rating. They plug a bunch of things in, like I was saying. Think about what the things are, the components, the financial components of a firm are that should predict their general credit worthiness. Well, credit rating agencies have done just that, only they've done it in a really thorough way, and they've been doing it for a long time, so they've got a pretty complex model. We don't know what that model is. It's all proprietary. These aren't like government agencies, and that's a whole other ballgame. So they're not proprietary. It's a proprietary model. We don't know what exactly is in it, but we do have a general idea of what makes a firm financially healthy and stable or not. So there's a couple of models that you can use to sort of approximate your own level of credit risk. This is probably the most famous one. It's called a Z-score. The Z-score is just a model that incorporates 5 different measures of financial health. So working capital to total assets, retained earnings to total assets, how much cash we have on hand, or EBIT over total assets. That's sort of like interest coverage in a sense that it's how much money we have before we have to pay interest as a ratio of how many assets we have in total. Market to book, this is a measure of our growth, no, that's not market to book. That's market value of equity divided by book value of liabilities. That's like equity to debt ratio. So this is our capital structure ratio. Sales to assets as a measure of efficiency. In the academic world, the Z-score is not given that much weight because its ability to predict default is really poor. In the practical world, it remains one of the most practical things we can do. In other words, once we get to this point where we don't have a credit rating, we don't have prices trading, we're sort of at our wit's end. We're grasping for straws. And Z-score is one of those straws. It doesn't perform that well, but ultimately in the end, neither does credit rating. Not that well. And our ability to predict failure and default is not that good to begin with. So by the time we're down here, we're sort of just taking whatever's best. So we can use Z-score. It does correlate pretty well with credit rating in general. But again, credit rating doesn't do that good a job of predicting default and failure anyway. So correlating pretty well with something that doesn't do a very good job is not really the best selling point in my mind. But we can use Z-score as a way to estimate our own credit rating. And then again, once we've got our measure of that, we can use the same methodology to get a default premium. What are all the other firms that have a similar Z-score? What is their premium? Can we plug that in? Okay. So there's some discussion here about the academic side. Is it still relevant? The general answer from the academic point of view is no, this is not a very good model. There's more and better models that do a much better job of predicting default. The problem is they're way more mathematically complicated, which makes it a lot more difficult to just have to make that the standard way to do this. Because not everyone will be able to understand or fully utilize the model if it's so complex. So people fall back on what's known and what's easy, and Z-score is known and easy. But we can do other things. We can try to figure it out. We try to estimate the different components that might make up a credit rating agency's model. And so we can look at a bunch of different measures like return on capital, like interest coverage ratio, like the EBITDA interest coverage ratio. We can see that when we sort firms based on these different measures, they do tend to fall into bins, right? So if we look at these, 8 measures, 8 ratios, and we sort firms based on the score on those ratios, it does turn out that firms tend to sort into the bins based on their credit score, meaning these things do seem to play a part in the models that credit rating agencies use. But again, we don't know exactly what part they play. What level of importance should I put on return on capital versus the interest coverage ratio, right? If a firm has a really high ROIC but doesn't have a very good interest coverage ratio, are they AAA? Are they AA? Are they A? We don't really have a good understanding of that based on what the credit rating scores are. And again, even the credit rating agencies don't do that good a job of predicting failure and default. So we sort of are in this realm where we're just trying to hope for the best. There's lots of room for improvement here. There's lots of room for someone to come up with a better model that helps us predict default in a more systematic way. It just doesn't quite exist yet. But our goal in doing that would be to come up with a better default premium, which would be a way to better price firms' debt, to better estimate the cost of debt, and in turn get a better valuation of the company because we have a better estimate of the cost of capital. I skip this last slide. There's more. This is more complicated than just one slide to do it justice, and ultimately, with a shortened schedule, just ignore it. That there is more to say about the cost of debt, particularly when we're talking about companies that are financially distressed. And we'll leave it at that. And if you're more interested, I'm happy to talk more about it one-on-one. So that's all I got. That's the end of chapter 13. We only got a couple more chapters to go, a couple more lectures to go before the third exam. The remaining chapters are short too, so expect them to be not a ton of material left here. So I hope you guys are doing well, and we'll see you next week.